It is time to take a look at your money this morning here on Good Morning Quad Cities. We start with the weekly stock market recap. The S&P 500 is down about 2%, the NASDAQ is down about 3%, and the Dow Jones Industrial Average is down 1.7%. On Wednesday, the U.S. Federal Reserve cautioned Americans it will soon begin raising interest rates much faster than previously expected. The Federal Reserve announced its decision as the nation confronts the highest level of inflation in decades. Financial advisor Mark Grywacheski is joining us now live this morning. Mark, good morning. What is the reason behind the Federal Reserve suddenly deciding to change these interest rates?
Good morning to you, Josh. I certainly want to wish you, Andrew, everyone in the control booth, and definitely all of our viewers a very Merry Christmas. Hard to believe just 5 days left. But to get to your question, over the past 12 months, consumer prices have risen 6.8%, a 39-year high. And as I said last week, I do think inflation will get worse before it starts to get better. But if inflation starts to get too high and prices start to get out of control, it risks a sudden collapse in consumer spending because, look, people simply can't afford to buy things anymore, and it risks potentially sending the economy into a recession. So the Fed starts, to raise interest rates to essentially disincentivize buying goods and services on credit. You're going to be charged a higher interest rate to borrow money on your purchases, and the goal, Josh, is to kind of gently tap the brakes on consumer spending, which should lead to a gradual reduction in prices.
Now, in what ways will Americans or even small businesses be impacted by these rising interest rates?
If you typically pay with cash, or if you do use a credit card, but pay off that balance in full at the end of each month, that is a way to minimize the impact of these higher interest rates. But if you do carry a balance on your credit card, which, look, many Americans do, or you do plan to take out some type of a bank loan, a car loan, home equity line of credit, or you plan on buying a home, you are going to be charged a higher interest rate on that debt. And for small businesses, especially, Josh, who often don't have these large, sums of money sitting in a bank account, they'll be facing higher interest rates as well to finance their purchase of supplies, machinery, and equipment.
So what exactly is the process for how the Federal Reserve goes about raising these interest rates?
Well, we're certainly not going to get into the minutia of the U.S. Federal Reserve this morning, but the U.S. Federal Reserve, does serve as the decision-making body for America's monetary policy, and part of that responsibility, Josh, is to keep inflation in check. And one of its main tools within its arsenal, I guess you could say, is the management of the benchmark Fed funds rate, which short-term debt is often based. So when the Fed starts to raise interest rates, i.e. through the Fed funds rate, you'll see interest rates on short-term debt, such as credit cards and bank loans, that will also start to go higher. But to get to this, this extreme level of inflation under control, the Fed will also be raising interest rates on what we call midterm and long-term debt as well. So you're going to be seeing higher interest rates on a 10-year mortgage, a 20-year mortgage, even a 30-year home mortgage.
And that million-dollar question everybody's going to be asking, how long do you think the Fed will continue to raise these interest rates?
A lot of it, Josh, depends on how long it takes to get this inflation under control. Now, look, one can easily argue the Federal Reserve should have started raising interest rates, much earlier this year to help address this inflation. But as a rough guideline, Josh, I think we should expect the Fed to continue raising interest rates for the next 3 years to get this inflation under control.
All right, good information for us. Thank you, Mark, for joining us here on Good Morning Quad Cities this morning. We will see you next Monday.
Enjoy the rest of your week, and again, Merry Christmas.
Merry Christmas to you too, Mark.